Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing the dollar index and the COVID-19 effect. The dollar index is also known by the following acronyms, the DXY or DX or USDX. The United States dollar is the single largest currency traded in the Forex market. The US dollar index is a weighted measurement of the value of the United States dollar against 6 other currencies, including the euro, Japanese yen, Australian dollar, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. The values of the dollar index are updated every few seconds during normal market trading activity. If you like to trade any of these pairs, it is advisable that you keep an eye on the US dollar index at all times. This is a historical 6-month view of the dollar index, and although the pandemic was already starting to escalate in February, the disease was mostly affecting Europe and Asia, and after a move lower, the index climbed to a high of 103.00 just 1 month later due to its safe haven status. However, this healthy level for the United States dollar has fallen off since that high to a low of 92.54 at the beginning of August. This dollar fall has largely been due to the fact that Europe is seen to be recovering from the coronavirus, and where governments such as the European Union and the British have been seen to be implementing monetary policies which will be good for the recovery of their respective economies. Australia has handled the pandemic very well, and where the infection rates have been quite low in that country. On the flip side, we have the United States, which is systematically failing in coming to grips with the corona outbreak, which has been escalated in many of the US states. While the Federal Reserve have been wildly applauded for their implementation of quantitative easing and handling of the interest rates in reaction to the escalating economic fallout, President Donald Trump has been criticized for not taking the disease seriously enough, and many would say that he's had his head buried in the sand, hoping it will go away. Much of this rhetoric surrounding the disease is tilted towards the upcoming presidential elections. This has caused the markets to wonder if America will actually get a grip on this horrendous disease, and this has caused the market sentiment to shift away from the United States dollar in favor of the other major currencies. They've all pulled back from their lows when Europe was very badly hit back in March. On Friday the 7th of August, the non-farm payroll reports took a little bit of heat from the DXY, when it posted jobs growth of 1.76 million in the United States for July, which went on to raise some of the concerns about the state of the United States labor market, and this in turn gave the dollar index a lift. In fact, it was up 0.6% at 93.40, a 3-day high, but this was still only bouncing off the lows of 7 weeks in straight declines. While the boot has been firmly put to the US dollar in the last few months, it is important to remember that 1 month's good US job figures may not be enough to raise the US dollar index back to the highs we saw in March. The next biggest test will be whether or not the US government can agree on a new pandemic relief package. So far, the Democrats and Republicans have been at each other's throats and not being able to come to a successful conclusion on the matter with regard to how much relief is necessary. Watch this space as the outcome will affect the dollar index. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.